Welcome to this explainer. Today, we're diving into a seriously perplexing market phenomenon. We're looking at a wild situation where major fintech companies are absolutely crushing their earnings expectations, delivering these incredibly dominant statistics, and yet, somehow, they're still watching their stock prices plummet. It's a paradox that has left a lot of investors totally scratching their heads. I mean, think about it, like a heavyweight boxing match. What actually happens when you land every single clean shot, you completely dominate the ring, but you still somehow lose the decision? That is exactly what we're seeing play out in the market right now. So today, we're going to frame 3 recent, highly anticipated earnings reports as rounds in a fight, breaking down exactly how you can win the numbers game but still get sent to the mat by investors. Okay, let's dive into this tale of the tape. Here's our agenda for today. First, SoFi's missed layup. Second, Robinhood's crypto hangover. Third, LMND's hot growth engine. And finally, number 4, the price of perfection. All right, stepping into the ring for round 1, we have section 1, SoFi's missed layup, winning the quarter. To really get what happened here, we need a little bit of context. Founded back in 2011, SoFi built its original business on refinancing student loans. But under the leadership of CEO Anthony Noto, who you might know as the former Twitter CEO, well, the company has completely morphed. They are a full-stack neobank now. They offer lending, banking, and investing, basically the whole shebang, all seamlessly integrated under one login. And heading into Q2 2024, they were gearing up for a truly record-breaking quarter. And wow, break records they absolutely did. SoFi essentially put up a financial triple-double. They posted an adjusted net revenue of $1.2 billion. To put that in perspective, that's a massive 40% upward growth year over year. And this was backed by a record $14.8 billion in loan originations, plus a 35% surge in their user base, bringing them to a massive 15.8 million members. And this brilliantly illustrates how the dominance just continued across the board. Their adjusted earnings per share came in at 12 cents, beating the 11-cent Wall Street consensus, and jumping 50% from a year ago. Management was actually so confident in these numbers that they even raised their full-year revenue guidance to a range between $4.75 billion and $4.85 billion. Anthony Noto called the quarter a clear inflection point, and frankly, the underlying numbers absolutely backed him up. But then came the whiplash. The stock sank roughly 10%. Why? Well, because Wall Street didn't just want a great quarter. They wanted SoFi to raise its adjusted EBITDA and EPS guidance too. When that specific guidance held flat, traders essentially treated a genuinely strong, dominant quarter like a missed layup at the buzzer. SoFi won the quarter, but they got punished for not delivering an even better one. It's crazy. Okay, moving on to round 2, section 2. Robinhood's crypto hangover. Beating big, bleeding. So let's recall where Robinhood started. Founded in 2013 by Vlad Tenev and Baiju Butt out in Menlo Park, this is the company that really built its name by gamifying zero-commission trading. They catered to an entire generation raised on push notifications and, confetti animations. Now, fast forward to Q2 2024, and they've been expanding their bets far beyond those early days and hitting some massive new records. I mean, the numbers they posted were just phenomenal. Robinhood delivered Q2 revenue of $1.31 billion, which is up 32% year over year. But the real showstopper? That was their GAAP EPS of 62 cents. That completely blew past the 43-cent estimate by a whopping 44%. No small feat. Now, what's really interesting here is we're seeing a tale of 2 completely different trajectories. Look at their diversification momentum. Equities trading volume jumped 95%. Prediction markets rocketed more than 10 times year over year to $156 million, heavily driven by World Cup betting, by the way. Options revenue grew 29%, and their premium gold subscribers climbed 39% to 4.8 million. They are clearly successfully diversifying. But look at the bottom. Crypto revenue actually fell 38% down to $100 million, mostly as enthusiasm for digital assets cooled off from last year's frenzy. And just like SoFi, we get another massive whiplash here. Despite hitting a record $21.7 billion in net deposits and diversifying away from that crypto dependency in real time, shares slid hard. Investors just zeroed right in on a cautious expense outlook and that crypto slump. Robinhood's fortunes still swing pretty heavily with the retail mood, and right now it seems investors are grading them on last year's crypto-frenzied curve. All right, ringing the bell for round 3, section 3. Lemonade's growth engine, running hot. Lemonade was founded back in 2015 in New York with a radically different approach to insurance. They built their entire reputation on AI-driven underwriting, basically offering an app that replaces traditional insurance brokers with highly efficient chatbots. Over the years, they've evolved massively. They've expanded from basic renter's insurance into home, pet, car, and life coverage. Their whole foundation is built on scale and automation. And man, that scale is paying off in a huge way. They reported Q2 revenue of $294.4 million. That is a blistering 79.4% revenue growth year over year, which completely beat Wall Street's top-line estimate. Not only that, but their guidance for the next quarter came in above expectations too, at a $324.5 million midpoint. Let's be totally clear here. Revenue growth this strong is the kind of number most insurers would literally frame and hang on the wall. Alongside this blistering growth, they posted a GAAP loss per share of 56 cents, which actually was roughly right in line with the consensus. They also announced a pretty major transition in leadership. Longtime CFO Tim Bixby will be transitioning to Lemonade's board in 2027, officially handing the CFO title over to the current SVP of Finance, Nick Stead. But here comes our final whiplash. The stock dropped 24% on the day. Nearly a quarter of their market cap just vanished. Why? Well, because Lemonade's stock had recently roughly doubled over the prior months. So investors looked at a report that was, great, but maybe not great enough to justify the multiple, and they treated it like an unstudied pop quiz. They sold first and asked questions later. Which brings us to the final decision of our fight. Section 4, the price of perfection, a brutal market. So the crucial point here is this. We are looking at an environment where even a huge beat can leave a deep bruise. SoFi delivered statistically dominant numbers, but they were punished for holding their guidance flat. Robinhood successfully diversified their business, but they suffered because investors just couldn't look past the crypto hangover. Lemonade's growth engine ran incredibly hot, but the stock had run even hotter, leaving absolutely zero room for anything short of utter perfection. All three won their rounds statistically, for sure, but they lost the day to investors demanding totally flawless execution. This entire phenomenon is perfectly captured by this quote from our source material. Good news needs a receipt, and great news apparently needs two. Let that sink in for a second. It is really the ultimate definition of today's deeply unforgiving market psychology. You can land every single clean shot, but if it isn't perfect, the market will still count you out. Which leaves us with one final critical question for you to consider. How will you navigate a market that demands absolute perfection? When the fundamentals are strong but the reactions are just brutal, staying informed and understanding the deeper narrative is your best defense. Don't let the surface-level numbers fool you, and never be caught off guard by the next brutal earnings season. Keep learning, keep analyzing, and we'll see you in the next explainer.